Hi dear, welcome to Trader's Mind Code. Why you keep losing money in trading. No one talks about this trap. Introduction. The trap they never warned you about. If you're losing money in trading, you're not alone. In fact, you're walking the same path that thousands, maybe millions, have walked before. Some gave up. Some kept trying. A few figured it out. But the truth is, most never understood what was really working against them. Not the market, not the broker, not the indicators or the strategy. Something much deeper. You see, when most people first step into the world of trading, they enter full of hope, excitement, and a little bit of fear. The promise is seductive. Make money from your laptop, work from anywhere, become your own boss. Escape the 9 to 5 grind. And that promise, whether whispered in a YouTube video or shouted in a trading course ad, plants a powerful image in your mind. But very few talk about what happens next. What happens when you lose your first big trade? What happens when you win a few trades, only to give it all back and more? What happens when you start feeling like the market is playing games with you? This book is about that hidden side of trading, the side no one talks about on day one. The trap that's waiting just beneath the surface. That it's not about which strategy you're using. It's not about which asset class you're trading, stocks, forex, crypto, it doesn't matter. It's about something that lives within you. There's a silent, invisible trap built into the way most people approach trading. A mental loop, a psychological maze. And most traders stay stuck in it for months or even years, losing money, jumping from one method to the next, and wondering, why isn't this working for me? Here's the truth. You don't lose money because you're unlucky. You lose money because of how you think, because of how you react, because of how you make decisions when real money is on the line. And that is the trap. This isn't about shaming or blaming. It's about exposing the hidden mechanics of failure so you can finally take control. You see, trading isn't just a financial game. It's a psychological war against fear, greed, doubt, ego, and impulse. And no one teaches you how to fight that war. They give you technical tools. They give you strategies. But they don't give you the mental weapons you truly need. That's what this book is for. In the chapters ahead, we'll walk through the invisible traps that keep most traders stuck and show you how to break free from each one. We'll talk about emotional triggers, mindset traps, common lies in the trading education world, and the dangerous beliefs that destroy trading accounts. And yes, we'll also talk about how to rebuild, how to trade with clarity, control, and confidence. This is not another get-rich-quick book. It's not filled with hype or false hope. It's a mirror, a map, and a message. You can become a successful trader, but not until you face the real reasons you're losing money. This is where it begins. This is where the truth comes out. Welcome to the trap they never warned you about. Now let's dismantle it, one chapter at a time. Chapter 1. The illusion of quick riches. It usually starts with a spark. Maybe you saw a YouTube video with flashy cars and live trades. Maybe someone posted a screenshot of a $1,000 gain in a single day. Or maybe you heard the story of a regular person, just like you, who made it in trading and never looked back. That it's magnetic, isn't it? The idea that with the right setup, a little knowledge, and some screen time, you could be pulling money out of the market whenever you want. No boss, no deadlines, just you and the charts. Freedom, fast money, full control. That illusion, the promise of fast wealth, is what pulls most people into trading. And it's incredibly powerful. It makes you believe you've found a shortcut. You tell yourself, I don't need to work 20 years to build wealth. I can do this. I just need the right indicator, the right system, the right strategy. But here's the truth that most new traders learn the hard way. The market doesn't pay you for showing up. It doesn't care how badly you want it. And it especially doesn't reward impatience. This illusion of quick riches is the first and most dangerous trap in trading. It's what causes people to risk too much too soon. It's what makes them skip the learning process. And it's what makes them fall apart the moment things don't go as expected because they weren't really prepared. They were chasing a fantasy. Think about it. Would you expect to become a successful surgeon after watching a few YouTube videos? Would you try to fly a plane after reading a blog post? Of course not. But in trading, people jump in with real money, real emotions, and real expectations, Without building real skills, that's the danger of the illusion. It whispers, "This will be easy." It convinces you that a few winning trades mean you've figured it out, and it keeps you focused on results instead of the process. Let's break that down. Most people come into trading with what's called a results-driven mindset. They think, if I'm making money, I'm doing it right. If I'm losing money, I'm doing it wrong. But the truth is, in trading, you can do everything right and still lose a trade. And you can do everything wrong and still win. That's what makes trading so tricky, that you're not just fighting the market, you're fighting your own expectations. When you believe trading should make you rich quickly, every loss feels like a failure. Every red candle feels like rejection. Every missed opportunity feels like a personal attack. But here's the reality. The traders who last, those who succeed, don't chase fast money. They chase mastery. They play the long game. They treat trading like a business, not a lottery. They focus on process, discipline, and patience. And that's exactly why they win in the end. Now, you might be thinking, but I've seen people make thousands in a single trade. Yes, that happens. But what you don't see is how many accounts were blown trying to get there. You don't see the losses, the sleepless nights, the emotional breakdowns. The illusion hides that part. It only shows you the highlights, the wins, the money, the lifestyle, but not the painful journey it took to get there. And definitely not the thousands of people who tried and failed. If you want to break free from this trap, you need to let go of the fantasy. Let go of the idea that trading will make you rich overnight. Because as long as you believe that, you'll keep making the same mistakes. Over-leveraging, taking impulsive trades, chasing losses, ignoring your rules, switching strategies every week. You'll trade like a gambler, not like a professional. And make no mistake, the market knows how to take money from gamblers. It does it every day. So here's your first real shift. Stop trying to get rich quickly. Start trying to get good slowly. Commit to becoming a skilled, disciplined trader, regardless of how long it takes. Because once you stop rushing, once you stop chasing the shortcut, that's when real growth begins. That's when you start seeing the market clearly. That's when you stop reacting emotionally. That's when you start trading with intention, not desperation. This chapter is your invitation to let go of the illusion. It's time to stop chasing money and start building a mindset that attracts it. The fast money fantasy has cost too many traders too much. Don't let it take more from you. You're here for the long game now. And that's where the real success is found. Chapter 2. Overconfidence. Your silent assassin. There's a quiet moment every trader remembers. The first big win. Might have been a lucky guess. Maybe you jumped in on a trend at the right time. Maybe you doubled your account in a day. Whatever the details, the feeling is the same. I've figured it out. That feeling is dangerous. Not because you're winning, but because of what the win does to your mind. You see, the most deceptive phase of a trader's journey doesn't begin with failure. It begins with success, and not the slow, earned kind of success. The fast, unexpected wins. The moments when you make more in one trade than most people make in a week. Those moments plant a seed in your brain. A seed called overconfidence. At first, it feels empowering. You think, this is easy. You believe, I'm different. I'm naturally good at this. You start to feel untouchable, and that's exactly when the trouble begins. Because overconfidence doesn't scream. It whispers. It doesn't tell you you're in danger. It tells you, you've got this. It doesn't say, you're making a mistake. It says, you don't need to follow the rules. You're beyond them now. Overconfidence is a silent assassin. It slowly kills your discipline, your humility, and your risk management, all without you noticing. You begin risking more than you should. You take trades that don't meet your criteria. You stop reviewing your losses because you assume they're just bad luck. And when the losses pile up, because they will, your ego goes into panic mode. Instead of stepping back, you double down. You chase. You revenge trade. You keep trying to prove that your early success wasn't just a fluke. Let's be clear about something. Confidence is essential in trading. But true confidence is built on evidence, patience, and experience. Overconfidence is built on emotion, assumption, and denial. They may feel similar in the moment, but they lead you to very different outcomes. Confidence says, I've practiced this. I've prepared. I'll take the trade and manage the risk. Overconfidence says, I've won before. I'll win again. Let's go big. One is grounded. The other is reckless. And the market has a brutal way of humbling the reckless that if you've ever blown up a trading account after a winning streak, you know this already. What you thought was progress was actually a setup. A setup for your ego. A setup for your emotions. And the trap was your own belief that you couldn't lose. Here's a hard truth most traders learn too late. The market doesn't care about your last trade. It doesn't care how smart you are, how many hours you've studied, or how good your past performance was. Each moment is new. Each trade is unique. Each decision must be made with clarity. Overconfidence clouds that clarity.it blinds you to risk. It tricks you into thinking you don't need discipline. And it feeds on your desire to be right, more than your desire to be consistent. So how do you kill this silent assassin before it kills your trading career? You start with awareness. You accept that one or two good trades don't define your skill. You remind yourself that the goal is not just to win, but to stay in the game. Professional traders don't get excited about single trades. They focus on the long run. They stick to their plan. They follow their rules, especially after a win. Why? Because they know the most dangerous moment in trading is right after success. That's when you're most likely to relax your discipline. That's when you're most vulnerable to yourself. So, here's your takeaway. Never let a win make you arrogant. Let it make you humble. Never let early success define your identity. Let it remind you how little you control. Never trade like the market owes you anything. It doesn't. The best traders aren't the most aggressive. They're the most self-aware. They recognize the voice of overconfidence. And they shut it down before it turns their biggest win into their biggest regret. The next time you have a winning streak, ask yourself, am I still following my rules? Am I managing my risk the same way I did before I started winning? Am I trading with confidence or overconfidence? One leads to growth. The other leads to destruction. Choose wisely. Chapter 3. The Education Trap. Learning the wrong things. Most new traders make the same assumption when they start losing money. I need to learn more. So, they dive into YouTube videos, buy courses, join Telegram groups, and download PDFs, promising the secret to profitable trading. They start learning about candlestick patterns, support and resistance, Fibonacci levels, moving averages, RSI, MACD, Bollinger Bands, Elliott wave theory. The list is endless. And on the surface, this seems like a good thing. After all, more education should equal more success, right? Not necessarily. Here's the trap. It's not that you're not learning. It's that you're learning the wrong things, or in the wrong way. Let's break that down. Most trading education is centered around technical knowledge, charts, indicators, patterns. But trading success doesn't come from just knowing technical setups. It comes from mastering how you use those setups in real time, under pressure, with money on the line, while your emotions are firing on all cylinders. In other words, most education teaches the what, but not the how. You learn what a head and shoulders pattern looks like, but you don't learn how to sit patiently through a trade when your profit is floating and you're tempted to close early. You learn what a trend line is, but you don't learn how to stay objective when your bias is screaming that price should go the other way. The result? You become a trader who knows a lot, but can't apply it consistently. You become overloaded with information, jumping between systems, switching indicators, trying to find the one that finally works. And that constant search, the endless pursuit of more knowledge, is a distraction. It makes you feel productive, but it keeps you from facing the real issue, your behavior, your discipline, and your mindset. Let's go deeper. There's a huge industry built around selling trading education, and much of it is designed to keep you dependent, hooked on new strategies, new indicators, and new ideas. You're constantly chasing new content, but rarely stopping to master the basics. Rarely asking, am I applying what I already know correctly and consistently? That's the trap. You think you're progressing because you're learning, but what you're actually doing is hiding behind information. Learning is easy. Execution is hard. Reading a PDF doesn't challenge your psychology. But placing a real trade and holding it according to your rules, that tests your discipline, your patience, your fear, and your greed. And that's where most traders fail. They don't need more strategies. They need to refine what they already know. They need to practice applying it under pressure. They need to build habits, not just gather knowledge. Let me ask you this. How many times have you switched strategies this month? How often do you study your own past trades to learn from your mistakes? Do you have a trading plan you actually follow, or just ideas in your head? The truth is, trading is not a game of who knows the most. It's a game of who executes the best. And that execution comes from focus, not from being overwhelmed with 50 tools and 20 theories. The traders who win aren't the ones who studied every indicator. They're the ones who picked a simple strategy and got really, really good at applying it. They understood that mastery beats variety. Every time. So here's the shift you need to make. Stop chasing more knowledge. Start mastering fewer things. Get back to the basics. Track your trades. Study your own behavior. Learn how your mind reacts in real time. That's where real growth lives. That's where consistency is built. And that's what most trading education won't teach you, because there's no shortcut to it. The education trap is seductive. It promises clarity. It promises control. But what you really need is experience, reflection, and repetition. In the next chapters, we'll dive deeper into the mental and emotional traps that keep you stuck. But remember this: information won't make you profitable. Application will. Focus on becoming a better decision maker, not just a better chart reader. That's the real education you need. Chapter 4: Emotional Trading. How fear and greed rob you. There's a moment in every trader's journey when the strategy goes out the window that you've studied. You've practiced. You know the setup. But when it's time to pull the trigger, when real money is on the line, everything changes. Suddenly, your hands hesitate. Or you enter too early. Or you exit too soon. Or you stay in too long, hoping, praying, bargaining with the chart. Why does this happen? Because trading is not just technical, it's emotional. And unless you learn how to manage those emotions, specifically fear and greed, they will rob you of every good decision you've ever prepared to make. Let's talk about fear first. Fear. In trading wears many masks. There's the fear of losing, which makes you hesitate. There's the fear of missing out, which makes you jump into bad setups. And there's the fear of being wrong, which makes you ignore what the market is telling you. Fear can make you skip trades that align perfectly with your plan. It can make you exit too early just to avoid watching a small pullback. It can make you hold on to losers, hoping they'll reverse, because you can't stand taking another red trade. And the worst part? Fear feels rational in the moment. It tells you, protect yourself. It whispers, maybe wait a little longer. But what it's really doing is pulling you away from your process and into survival mode. Now let's talk about greed. Greed is more subtle. It usually shows up after a few wins. You start feeling good, confident, maybe even a little invincible. You tell yourself, if I just hold this trade a little longer, I can make double. You start ignoring your take profit levels. You start risking more on each trade, because greed doesn't say, be reckless. It says, just this once. It says, you deserve more. And in that moment, it convinces you that more is always better. But here's the truth about both fear and greed. They are not problems to eliminate. They are forces to understand and manage. You will always feel emotion in trading. That's part of being human. But you don't have to let emotion control your decisions. You can feel fear and still follow your plan. You can feel greedy and still close the trade when you're supposed to. You can learn to act based on logic, not on instinct. How? Through structure, through repetition, through self-awareness. Here's what most traders don't realize. Your emotions aren't just reactions to the market. They're responses to your expectations. If you expect every trade to be a winner, you'll panic the moment it goes against you. If you expect the market to move exactly how you predicted, you'll get frustrated when it doesn't. But if you expect uncertainty, if you accept that losses are part of the game, your emotional response starts to change. You stop reacting. You start managing. You begin to trade from a place of control, not chaos. Let me ask you a few simple questions. Do you feel anxious every time you place a trade? Do you stare at the screen, watching every tick, unable to walk away? Do you double your risk after a loss, hoping to make it back? Do you break your rules after a few wins, thinking you're on a streak? If the answer is yes, you're not alone, but you are trading emotionally. And until you address that, no strategy will save you, because fear and greed don't care how advanced your indicators are. They don't care how many hours you've studied. They only care about one thing: getting you to react instead of respond. So how do you stop trading emotionally? You create a plan, and you stick to it no matter what you feel. You define your entry and exit rules before the trade, not during. You size your positions so that any loss is acceptable, not devastating. You journal your trades, not just the results, but your feelings and thoughts. You step away from the screen when you feel triggered. You build self-awareness like it's your most valuable asset. Because it is, trading is not about being emotionless. It's about being emotionally intelligent. You will feel fear. You will feel greed. But you do not have to let them take the wheel. The best traders don't suppress emotion. They recognize it. They pause. And then they act with discipline. That's how you win. Not just once, but consistently. Because in trading, your biggest threat is not the market. It's how you react to it. Master your emotions, and you begin to master the game. Chapter 5. The Gambling Mentality. Not all risk is reward. Let's be honest, there's a fine line between trading and gambling. And for many traders, especially those just starting out, that line gets crossed far more often than they realize. It doesn't matter how sophisticated the platform is or how advanced the indicators are. If your decisions are driven by impulse, by hope, by desperation, you're not trading, that you're gambling. And that mindset, over time, will quietly destroy your account. Here's the difference. A trader manages risk. A gambler chases reward. A trader knows that not every trade will work. So they control what they can: position size, stop loss, take profit, and discipline. A gambler, on the other hand, focuses on the thrill, the payout, the big win. And the gambler convinces themselves they're being smart because they use charts, because they've read a book, because they follow someone on Twitter who called the last move. But deep down, they're still guessing, still hoping, still trying to turn one lucky trade into a lifestyle. Let's talk about what this gambling mindset actually looks like in practice. You revenge trade after a loss, trying to win back what you just lost. You risk too much on a single setup, thinking, this is the one. You ignore your stop loss and let a losing trade run, hoping it'll turn around. You chase price when it's already moved, just because you don't want to miss out. You jump from one strategy to another, never fully testing or mastering anything. Sound familiar? It's not because you're reckless. It's because you haven't yet made the shift from random risk-taking to calculated decision-making. The truth is, trading attracts gamblers. It's fast. It's exciting. It gives you instant feedback. And it promises, on the surface, the same thing a casino promises: make money quickly, without needing anyone else. But the market is not a casino. It's a battlefield. And if you show up without a strategy, without a mindset, without a plan, you will lose. Not because the market is unfair, but because you stepped onto the field thinking it was a game of chance, not a test of discipline. Now, here's what makes it even more dangerous. Sometimes, the gambling mindset gets rewarded in the short term. You take a risky trade. You over-leverage. You skip your stop loss. And somehow, it works. You make money. You feel like a genius. You think you've cracked the code. But what you've actually done is reinforced a dangerous habit. And eventually, that habit will cost you far more than you ever imagined. Because luck doesn't scale. And hope is not a strategy. So how do you break out of the gambling mindset? You start by accepting this. Not all risk is good risk. Not all reward is worth chasing. Real traders don't just ask, what can I make? They ask, what can I lose? They think in probabilities, not possibilities. They don't marry a trade. They manage it. They don't bet everything on a single setup. They build consistency over time. You have to change the way you define success. It's not about winning big. It's about making smart, repeatable decisions. It's about staying in the game long enough to learn and grow. Because in trading, survival is underrated, and consistency is everything. Here's a practical shift you can make today. Start thinking like a risk manager. Before every trade, ask yourself, what's the risk-to-reward ratio? Am I trading based on a plan or just reacting to what I see? Can I emotionally handle this loss if it happens? Would I take this same trade 100 times, knowing some will lose? If you wouldn't, don't take it. You're not here to feel excited. You're here to feel in control. The goal isn't to feel like you're winning all the time. The goal is to win over time by thinking, acting, and planning like a professional. So remember this. Every trade is a test, not of your luck, but of your discipline. The more you treat trading like a business, the more likely you are to succeed. The more you treat it like a slot machine, the faster your money disappears. This is your moment to step out of the casino and into the mindset of a real trader, because not all risk is reward. But the right kind of risk, the disciplined, intentional kind, is the only path to long-term success. Chapter 6. Lack of a real plan. Winging it doesn't work. One of the biggest reasons traders keep losing money is because they don't have a real plan. Instead, they trade on impulse, guesswork, or feelings. This is often called winging it, and it's a trap that silently drains your account and your confidence. Trading without a plan is like trying to drive across a busy city without a map or GPS. You might get lucky and reach your destination, but chances are you'll get lost, frustrated, and waste a lot of time and fuel. The market doesn't owe you anything, and without a clear direction, you're left guessing and reacting to its every move. The truth is, successful trading doesn't come from hoping the market moves your way or from relying on gut feelings. It comes from having a clear, tested plan, a roadmap that guides your decisions step by step. This plan defines when to enter, how much risk to take, when to exit, and how to manage trades once you're in. Without this, you are vulnerable to the most dangerous forces in trading, your emotions. When you trade without a plan, you're more likely to enter trades that don't meet your criteria, driven by fear of missing out or the thrill of action. Risk more than you can afford because you don't set clear risk limits. Exit winning trades too early or hold on to losing trades too long because you don't have defined exit rules. Jump from one strategy to another, chasing the next holy grail instead of mastering one approach. This kind of inconsistent trading leads to frustration and losses. So, what exactly should a real trading plan include? Entry rules. Know exactly what conditions need to be met before you enter a trade. This could be a specific chart pattern, a signal from an indicator, or a confirmation of trend direction. No guessing, no improvising. Risk management. Decide beforehand how much of your capital you will risk on each trade. This usually means setting a stop loss at a level that limits your loss to a small percentage of your total account, often 1 to 2%. Protecting your capital is the foundation of long-term success. Exit rules. Determine in advance where you will take profits and where you will cut losses. Are you targeting a fixed price level? Will you use a trailing stop? Clear exit rules. Prevent emotions like greed and fear from dictating your decisions. Trade management. Decide how you will manage open trades. Will you scale out of positions? Move stops to break even? Knowing this in advance keeps you in control when the market moves unpredictably. Review and adjust. Regularly review your trades to understand what works and what doesn't. Learning from your own experience is critical for growth. Many traders avoid creating or following a plan because it requires discipline and patience, two things that can feel uncomfortable. It forces you to admit you can't control the market and that losses are part of the process. But without a plan, you're essentially gambling every time you click the buy or sell button. Imagine you have a plan and you follow it consistently. You know your entry points are based on tested criteria. You risk only a small percentage on each trade. You exit trades according to rules you set when emotions are calm. Even when you lose, it's manageable. Even when you win, it feels earned. That's the difference a plan makes. Winging it might feel freeing or exciting at first, but that feeling quickly turns into stress, confusion, and repeated losses. The market doesn't reward guesswork. It rewards preparation and discipline. If you want to stop losing money, you need a plan, and you need to follow it without exception. This is your best defense against emotional trading and impulsive decisions. Trading without a plan is like trying to win a game without knowing the rules. And you don't have to play that way. Start building your plan today. Define your rules, test them, and commit to following them no matter what, because winging it doesn't work. A plan does. Chapter 7. The Mirror Trap. Your mindset is the market. Imagine standing in front of a mirror. What do you see? Your face, your expression, your emotions. Now imagine the market as that mirror. What you see on the outside, the price movements, the volatility, the noise, is really a reflection of what's happening inside your mind. This is the mirror trap. Most traders spend all their energy trying to read the market to predict what it will do next. They study charts, analyze indicators, search for patterns. Yet, the hardest market to understand is often the one inside themselves. The market reflects your mindset, your fears, hopes, biases, and beliefs all shape the way you interpret price, action, and make decisions. If your mind is calm and disciplined, you see the market clearly. But if your mind is anxious, impatient, or fearful, the market becomes a chaotic and confusing place. This trap is dangerous because it tricks you into blaming the market for your losses. You tell yourself, the market is unfair, or it's manipulating me. But in reality, the market is neutral. It simply reflects your internal state back to you. Think about it this way. When you're fearful, you might see every small dip as a sign of disaster. You exit trades too early or avoid taking trades altogether. When you're greedy or impatient, you chase price moves, enter too early, or hold trades too long. When you're frustrated, you might make impulsive decisions or abandon your strategy altogether. In all these moments, the market is like a mirror showing you exactly what's going on inside your mind. The mirror trap means that to trade successfully, you must first master yourself. You have to become aware of your emotions, your biases, and your mental habits. You have to understand how your thoughts shape your perceptions and your decisions. Many traders never realize this. They keep blaming external factors, news, volatility, manipulation, while their mindset remains unexamined. This is why they repeat the same mistakes over and over. Breaking free from the mirror trap starts with awareness. Ask yourself, what emotions am I feeling right now? How are these emotions influencing my decisions? Am I reacting to the market or responding with a clear plan? Am I seeing the market clearly or through the lens of my fears and desires? This level of self-awareness is a game-changer. It allows you to pause before acting, to question your impulses, and to make decisions based on logic rather than emotion. It lets you see the market as it is, not as you wish it to be. Remember, the market doesn't care about your feelings. It moves on its own terms. Your job is to align your mindset with those movements, to become flexible, patient, and objective. The traders who succeed are those who look in the mirror and take responsibility for what they see. They know that the real battle isn't against the market. It's against their own mind. Here's your challenge. Start treating your mind like your most important trading tool. Practice observing your thoughts and feelings without judgment. Build habits that support clarity and discipline. And remember, every trade is an opportunity to learn, not just about the market, but about yourself. The mirror trap can either be your greatest obstacle or your greatest teacher. Which one it becomes depends on how willing you are to face yourself. Trading is a journey inward as much as it is a journey outward. Master your mindset, and the market will follow. Chapter 8. Overtrading and revenge trading. Trading is a test of patience as much as it is a test of skill. But when impatience and frustration creep in, they can push even the most experienced traders into dangerous territory. Two of the most common and costly pitfalls born from these emotions are overtrading and revenge trading. Let's explore what these traps look like, why they happen, and how you can protect yourself. What is overtrading? Overtrading happens when you take too many trades in a short period, beyond what your trading plan or strategy allows. It's driven by a feeling of urgency, sometimes boredom, sometimes desperation, sometimes the false belief that more trades mean more chances to win. You might find yourself clicking buy or sell over and over, chasing small moves, or reacting to every little price fluctuation. You become hyperactive, always in the market but rarely in control. The problem? Overtrading increases transaction costs, spreads your attention too thin, and often leads to poor quality trades. When you trade too much, you're not trading smarter, you're trading harder, and usually, you lose more. What is revenge trading? Revenge trading is the urge to get even after a loss. Imagine you just took a losing trade. It stings. It frustrates you. Instead of stepping back and regrouping, you jump right back in with bigger size, more risk, or less caution. You want to recover your losses fast, so you take trades out of anger or impatience. This is a dangerous emotional spiral. Revenge trading ignores your strategy and rules. It's impulsive, reckless, and it often leads to even bigger losses because you're not trading to win, you're trading to erase pain. Why do these traps occur? Both overtrading and revenge trading share a common root: emotional reactivity. When your mindset is unsettled by boredom, frustration, fear, or greed, you're more likely to make impulsive decisions. You lose focus on your plan and start chasing feelings instead of following rules. Overtrading might come from impatience or excitement. You feel like you have to do something to stay in the game. Revenge trading comes from frustration or anger. Your mind wants to right a perceived wrong immediately. Both behaviors are attempts to regain control, but ironically, they lead to more chaos. The consequences, the cost of overtrading and revenge. Trading is high. Increased transaction fees eat into your profits. You risk more money than you can afford to lose. Your emotional state deteriorates, causing poor decision-making. You stray from your tested strategies and rules. You create a cycle of losses and emotional reactions that's hard to break. Many traders find themselves trapped in this cycle, unable to stop trading even as their account dwindles. How to break free? Breaking free starts with awareness and self-control. Recognize the triggers, know what emotions or situations lead you to overtrade or revenge trade. Is it after a loss? During a streak of boredom? When the market feels slow? Identifying these triggers lets you pause before acting. Stick to your trading plan. Your plan includes rules about how many trades to take, risk limits, and when to sit out. Follow it strictly, even when the urge to trade feels strong. Set limits. Use daily or weekly maximum loss limits and trade counts. Once you hit these limits, step away. Discipline is knowing when to stop. Journal your emotions. Keep track of your feelings before, during, and after trades. This practice builds self-awareness and helps you spot patterns. Practice patience. Understand that sometimes the best trade is no trade. Markets have natural rhythms. Waiting for high-quality setups pays off more than constant action. Take breaks if you feel frustrated or impulsive. Walk away from the screen. Clear your mind before making any new decisions. Final thoughts. Overtrading and revenge trading are symptoms, not the root problem. The root is emotional control and mindset. Discipline.by mastering your emotions and respecting your plan. You transform trading from a roller coaster of impulsive moves to a steady journey of deliberate, calculated decisions. Remember, trading is a marathon, not a sprint. The best traders know when to act and when to wait. They don't fight their emotions, they manage them. Breaking these traps takes practice, patience, and commitment. But once you do, you'll find yourself trading smarter, calmer, and more consistently profitable. Chapter 9. Copy trading, signals, and false gurus. In the world of trading, shortcuts can be tempting. The idea of following someone else's trades, subscribing to trading signals, or trusting the advice of self-proclaimed gurus promises a way to bypass the hard work and jump straight to profits. But as with many things that sound too good to be true, these shortcuts often lead traders deeper into the trap. The allure of copy trading and signals. Copy trading platforms have grown rapidly in popularity. With just a click, you can mimic the trades of supposedly successful traders without doing the analysis yourself. Trading signals, alerts telling you when to buy or sell, promise expert guidance, taking the guesswork out of trading. For beginners or frustrated traders, these services feel like a dream come true. Why spend hours learning and developing a strategy when you can just follow a pro and make money? Unfortunately, this dream often turns into a nightmare. Why copy trading? And signals can be dangerous. First, let's be clear. Not all signal providers or copy traders are scams. Some are experienced traders sharing their strategies. But even the best traders have losing periods. Markets are unpredictable. No strategy works 100% of the time. Blindly copying trades or following signals without understanding the underlying reasons is risky for several reasons. Lack of context. You don't know why a trade was made. Is it based on technical analysis, news events, or a gut feeling? Without context, you can't adjust to changing market conditions. Different risk profiles. The trader you copy might be comfortable risking 10% of their account on a trade. You might only be able to afford 1%. Without adapting size and risk, you expose yourself to losses you can't handle. Emotional disconnect. When you don't make the trading decisions yourself, you don't develop the discipline or emotional resilience needed to manage winning and losing trades. You become a passenger, not the driver. Delayed execution. Signals might come too late or be missed, causing you to enter at the wrong time. Dependence and complacency. Relying on others stops you from learning and growing as a trader. You Become dependent on someone else's success instead of building your own. The problem with false gurus: the internet is flooded with self-proclaimed trading gurus promising fast riches. They sell courses, offer mentorship, boast about huge profits, and sometimes showcase luxury lifestyles to lure followers. But many of these gurus have little real trading experience. Use marketing gimmicks rather than sound education. Promote risky strategies that lead to quick losses for followers. Make money primarily from selling products, not from trading profits. Discourage independent thinking or questioning. Believing in false gurus can trap traders in a cycle of hope and disappointment. You pay for expensive courses or signal services, only to find your account shrinking. How to protect yourself: be skeptical and do your research. If someone promises guaranteed profits or quick riches, be wary. Look for verified track records, transparency, and realistic expectations. Understand what you're copying. If you use copy trading or signals, learn the reasoning behind each trade. Ask questions. Don't blindly follow. Manage your risk independently. Always set your own stop loss and position size based on your risk tolerance. Never risk more than you can afford to lose. Develop your own skills. Use copy trading or signals as learning tools, not crutches. Study charts, strategies, and trading psychology. Aim to become your own trader, not someone else's follower. Avoid hype and pressure. Don't rush into trades because someone says act now or limited time. Take time to evaluate and make calm decisions. The long-term truth: no one can trade your account better than you. Trading is as much about psychology, discipline, and personal growth as it is about strategy. Shortcuts may offer temporary excitement or even some wins, but they don't build the foundation for lasting success. Your best defense against copy trading pitfalls and false gurus is education, patience, and self-reliance. Build your knowledge. Practice with intention. Develop your own plan and trust your process. In the end, trading is a personal journey. No one else can walk it for you. Chapter 10. Why you don't stick to a strategy. One of the biggest challenges every trader faces is consistency. You may have a well-defined strategy, tested and proven, but somehow you still struggle to follow it. You find yourself deviating, second-guessing, or abandoning your plan altogether. Why does this happen? Why don't traders stick to their strategies, even when those strategies work? This chapter dives deep into the reasons behind this common struggle and offers insight into how you can break the cycle. The emotional roller coaster: trading triggers a powerful emotional response. Even the best plan can feel fragile when money is on the line. When the market moves against you, fear kicks in. You worry about losing your hard-earned capital. Your mind begs you to exit early, even if your strategy says otherwise. When the market moves in your favor, greed takes over. You want to hold longer, hoping for more profits. You ignore your exit rules and risk giving back gains. This emotional tug-of-war often leads you to override your strategy, chasing feelings instead of following logic. Lack of trust in your strategy. Another reason you might not stick to a strategy is that you don't fully trust it. Maybe you haven't tested it enough. Maybe you've had some losing trades that shook your confidence. Remember, no strategy wins 100% of the time. Losses are part of trading. But without trust, those losses feel like disasters, pushing you to make impulsive changes. Overcomplicating the strategy. Sometimes traders fall into the trap of complexity. They add multiple indicators, filters, and rules, hoping to catch every market move. But complex strategies are harder to follow consistently and more prone to confusion. When your rules become complicated, it's easy to skip steps or misinterpret signals. This inconsistency leads to abandoning the plan entirely. External noise and influence: trading doesn't happen in a vacuum. Social media, forums, news outlets, and friends offer endless opinions and advice. The fear of missing out or being wrong can push you to ignore your strategy and follow the crowd. This constant external noise makes sticking to your plan harder and increases doubt and second-guessing. Impatience and the desire for instant gratification. Trading success rarely comes overnight. It requires patience, discipline, and time. Yet, many traders want quick results and instant profits. When they don't see immediate success, frustration grows. They switch strategies, looking for the magic formula, instead of giving their current plan time to work. This impatience sabotages consistency and long-term growth. How to stick to your strategy, build confidence through testing. Test your strategy thoroughly on historical data and demo accounts. Understanding its strengths and weaknesses builds trust. Keep it simple. Focus on a strategy that's clear and straightforward. Simplicity makes it easier to follow rules consistently. Create clear rules and write them down. Define entry, exit, risk management, and trade management rules. Having written guidelines reduces impulsive decisions. Manage your expectations. Accept that losses are part of the game. Focus on the process and consistency rather than short-term wins. Limit external noise. Reduce exposure to conflicting opinions and hype. Stay focused on your plan and your own trading journal. Practice emotional discipline. Develop techniques to manage fear and greed, such as meditation, journaling, or taking breaks. Review and adjust methodically. Regularly analyze your trades to learn what works and what doesn't. Make gradual, data-driven adjustments instead of impulsive changes. Final thought: sticking to a strategy is not about perfection. It's about discipline, patience, and trust. Your strategy is your roadmap through the market's uncertainty. Abandoning it leaves you lost and vulnerable to emotional traps. Mastering the art of consistency sets great traders apart from the rest. So focus on building trust in your plan, managing your emotions, and committing to the process. In time, your discipline will become your greatest advantage and your key to lasting success. Chapter 11. Small losses add up. The compounding effect. When traders think about losses, they often imagine big, catastrophic hits. Massive trades gone wrong that wipe out a significant portion of their accounts in a single moment. But the truth is, the slow, silent enemy of most traders isn't the big loss. It's the small losses that pile up over time. These small losses may seem insignificant individually. A few dollars here, a couple of percent there. But they compound, like a leak in a bucket. Each small loss drains your capital, your confidence, and your ability to stay in the game. The nature of small losses: every trader experiences losses. It's unavoidable. No strategy wins every time. But small losses, when controlled and accepted, are a normal part of the process. The problem arises when those losses become frequent, or when you let small losses grow bigger by not cutting them. Quickly, small losses can come from taking trades that don't fit your plan because you think it might turn around, exiting winning trades too early due to fear, which turns potential profits into small gains or losses, ignoring stop-loss orders or moving them further away, hoping the market reverses, overtrading, which increases the number of losing trades. Why? Small losses are dangerous. The danger of small losses lies in their deceptive nature. They feel manageable, so traders often tolerate them more easily than big losses. But what seems small adds up faster than most realize. For example, losing 2% per trade may not sound alarming, but after 20 such losses, you've lost nearly 33% of your capital. That's a huge setback. More importantly, small losses chip away at your confidence and mental strength. You begin doubting your strategy, your decisions, and yourself. This self-doubt can lead to emotional trading, impulsive moves, and eventually bigger losses. The compounding effect. Compounding is a powerful concept in trading and investing. Just as profits can compound over time, so can losses. The difference is that compounding losses can destroy your account exponentially faster. Each loss shrinks your capital base, meaning your next trade has less to work with. To recover from a loss, you need even higher percentage gains, making the road to recovery longer and more difficult. For instance, if you lose 50% of your account, you need a 100% gain just to get back to break even. Small, repeated losses can quietly lead to such severe drawdowns without warning. How to manage small losses? Accept losses as part of trading. Understand that losses will happen. Accepting this fact helps you avoid emotional reactions that make losses worse. Use strict risk management. Always define your maximum risk per trade, often 1 to 2% of your capital. Stick to your stop-loss rules firmly. Cut losses quickly. Don't hope a losing trade will turn around. Accept the loss and move on. Quick exits protect your capital and your mental state. Avoid overtrading. Taking too many trades increases the chance of small losses adding up. Trade selectively and stick to your plan. Maintain a trading journal. Record each trade, including losses, and review them regularly. This helps you identify patterns and avoid repeating mistakes. Focus on long-term. Consistency trading is a marathon, not a sprint. Small, controlled losses paired with good wins create sustainable growth over time. The bigger picture small losses may feel frustrating in the moment, but they don't have to derail your trading career. If you manage them with discipline, they become stepping stones, learning experiences that help you improve your edge and mental resilience. But if you ignore them, underestimate their impact, or let emotions dictate your decisions, they become a downward spiral. The compounding effect is a double-edged sword. It can destroy or it can build. By respecting small losses, managing risk, and staying disciplined, you harness the power of compounding in your favor. This is the foundation of sustainable trading success. Chapter 12. Discipline versus Impulse. The final battle in trading. Every decision you make boils down to a single, ongoing battle: discipline versus impulse. This battle is the heart of why many traders fail, and why the few who succeed do so against great odds. Understanding the battle impulse is immediate, emotional, and often irrational. It urges you to act quickly, to chase the market, to make up for losses, or to jump into a trade just because you feel like it. Impulse thrives on fear, greed, excitement, and frustration. Discipline, on the other hand, is deliberate, patient, and logical. It keeps you grounded in your trading plan. It tells you to wait for the right setup, to respect your risk limits, and to follow through, even when it's difficult. This battle plays out every time you face a trading decision. Will you follow your rules, or will you give in to the temptation of a quick win? Will you cut your losses early, or hold on hoping the market reverses? Will you sit out a bad market, or overtrade just to feel like you're doing something? The choice is yours every single time. Why discipline is hard? Discipline isn't natural. It requires conscious effort, self-awareness, and sacrifice. When money is involved, emotions intensify. The desire for instant gratification is strong. Humans are wired to avoid pain and seek pleasure, two forces that work against discipline. Trading. Discipline means saying no to impulse trades. It means accepting small losses and missing out on tempting setups that don't fit your criteria. It means trusting a process that sometimes feels slow and boring. This is why discipline separates the successful from the unsuccessful traders. How impulse undermines success. Impulse leads to overtrading, taking too many trades without proper analysis. Revenge trading, trying to win back losses quickly, often with bigger risk. Ignoring stop losses, holding losing trades in hope of a reversal. Chasing the market, jumping into trades late because of fear of missing out. Abandoning your plan, making decisions based on emotion rather than logic. Each impulsive act chips away at your capital and confidence. Building discipline. Practical steps create clear, simple rules. Your rules are the foundation of discipline. Make them easy to follow and write them down. Automate where possible. Use stop loss and take profit orders automatically. This removes emotional interference in trade management. Use journaling to stay accountable. Record your trades and the reasons behind each decision. Review your journal to identify impulsive mistakes. Practice mindfulness and emotional awareness. Learn to recognize emotional triggers before they control your actions. Pause and breathe before acting. Set realistic expectations. Accept that losses and missed opportunities are part of trading. Focus on the long-term process, not instant results. Take breaks when needed. If you feel overwhelmed or emotional, step away from the screen. Return only when calm and focused. The power of discipline. Over time, discipline might feel like a daily struggle, but it compounds into consistent profits and growth. It allows you to protect your capital through proper risk management. Follow your trading plan with confidence. Build emotional resilience against market volatility. Learn from your mistakes without panic or frustration. Develop a mindset geared for long-term success. Final thoughts. Discipline versus impulse is not a one-time battle. It's a lifelong war every trader must face. The market tests your discipline constantly. It tempts you to stray, to gamble, to react emotionally. But every time you choose discipline, you strengthen your trading muscles. You move closer to mastery. Remember this: trading success is less about being right on every trade and more about having the discipline to manage your mistakes, control your emotions, and follow your plan consistently. This final battle, discipline versus impulse, is where fortunes are won or lost. Choose discipline. It's your greatest weapon in the trading arena. Final chapter, breaking the cycle, becoming the 2%. Throughout this book, we've explored the traps and pitfalls that cause most traders to lose money. From chasing quick riches to emotional reactions, from the lack of a plan to the silent dangers of small losses, the journey has revealed the hidden reasons why so many fall into the same pattern over and over again. Now, it's time to talk about something far more important, breaking the cycle. Becoming part of the elusive 2% who succeed where others fail. Understanding the cycle looks familiar to many traders. The excitement of starting, the hope of easy profits, the early losses and frustration, the emotional trading and abandoning of rules, the blow-ups and giving up. That it's a painful loop that traps 98% of traders. But it doesn't have to be your story. What sets the 2% apart? The 2% are not necessarily smarter or luckier. They don't have secret formulas or insider knowledge. What separates them is their mindset and approach. They have discipline. They follow their plan, no matter how tempting it is to stray. Patience. They understand that success takes time and consistent effort. Self-awareness. They recognize their emotions and manage them rather than being controlled by them. Resilience. They accept losses as part of the process and learn from every mistake. Continuous learning. They commit to growing their skills and adapting to changing markets. Risk management. They protect their capital above all else. Knowing survival is key to long-term success. How to break the cycle and join the 2%. Commit to a plan and follow it. Create a clear, simple trading plan with rules for entries, exits, and risk. Stick to it no matter what the market or emotions say. Master your mindset. Practice emotional discipline daily. Use journaling, meditation, or any method that helps you observe and control your feelings. Accept losses and learn. Stop fearing losses. See them as feedback and stepping stones. Analyze your mistakes and improve. Avoid the shortcuts and false promises. Ignore get-rich-quick schemes, signals, and false gurus. Build your own skill set patiently. Be patient and persistent. Trading is a marathon, not a sprint. Celebrate small, consistent gains over time. Review and adjust methodically. Regularly review your performance and refine your approach without rushing. The power of consistency. Success in trading isn't about hitting home runs. It's about hitting singles consistently. It's about managing risks so losses don't wipe you out. It's about steady growth, learning, and self-control. This consistency builds confidence and capital. It transforms trading from a gamble into a business. Your journey starts now. Breaking the cycle requires courage. It means choosing discipline over impulse, patience over greed, process over hope. It means being honest with yourself and committing to change, but the rewards are worth it. Imagine a future where you control your trading, your emotions, and your financial destiny. A future where you're part of the 2% who thrive, not just survive. That future is possible, and it begins with your next step. Final words, you have the knowledge. You understand the traps. You know the path forward. Now it's time to act, make the commitment today to break free from the cycle. Build your plan. Master your mindset. Trade with discipline. The journey will be challenging, but every step you take brings you closer to the freedom and success you deserve. Remember, the 2% aren't born, they're made, one disciplined decision at a time. Bonus: a 30-day trading discipline challenge. Discipline is the cornerstone of trading success. But like any skill, it takes practice and commitment to develop. That's why this bonus chapter offers you a 30-day trading discipline challenge, a simple, structured plan to help you build strong habits that will transform your trading mindset and results. By committing to this challenge, you take control of your trading journey, day by day, step by step. How the challenge works: each day for 30 days. You will focus on one specific action or mindset practice. These daily tasks are designed to build your self-awareness, reinforce your trading plan, and strengthen emotional control. You don't need hours, just a few focused minutes. Consistency is more important than intensity. The 30-day challenge. Week 1. Building awareness and structure. Day 1. Write down your trading plan if you don't have one. Create a simple plan with entry, exit, and risk rules. If you do, review and refine it. Day 2. Set your daily maximum risk. Decide how much capital you're willing to risk per day, e.g., 1 to 2% of your account. Commit to stopping trading if you hit this limit. Day 3. Journal every trade. Record all details. Entry, exit, reason for the trade, emotions before and after. Day 4. Identify your emotional triggers. Reflect on moments when fear, greed, or frustration affected your decisions. Day 5. Practice mindful breathing before every trade. Take 3 deep breaths to calm your mind. Day 6. Define your ideal trading environment. Choose a quiet, distraction-free space for trading and commit to it. Day 7. Review your trades for the week. Analyze your journal entries, focusing on discipline and emotional control. Week 2. Strengthening emotional control. Day 8. Practice patience. Wait for your trading plan setup without rushing. Count to 10 before placing any trade. Day 9. Use stop-loss orders religiously. Place stop-loss orders before entering any trade and never move them further away. Day 10. Visualize following your plan. Spend 5 minutes imagining yourself sticking to your rules under pressure. Day 11. Take a break when emotions run high. If you feel stressed or impulsive, step away from the screen for 10 minutes. Day 12. Limit social media and news. Avoid trading-related news and forums for the day to reduce noise. Day 13. Affirm your trading goals. Write down your goals and read them aloud to reinforce commitment. Day 14. Review and reflect. Look back at the week's trades and journal notes. Celebrate successes and note areas for improvement. Week 3. Enhancing consistency and focus. Day 15. Trade only your plan, no exceptions. Stick strictly to your defined strategy. Day 16. Set a maximum number of trades for the day. Limit your trades to prevent overtrading. Day 17. Focus on quality over quantity. Review your trades and identify your best setups. Day 18. Practice emotional detachment after closing a trade. Mentally let go of the outcome before your next trade. Day 19. Meditate for 5 minutes. Use a simple meditation or mindfulness exercise to clear your mind. Day 20. Use a timer to limit screen time. Avoid staring at charts endlessly. Check only at planned intervals. Day 21. Weekly review. Analyze your trading journal and identify patterns in discipline and impulse. Week 4. Building long-term habits. Day 22. Celebrate small wins. Acknowledge progress, no matter how small. Day 23. Adjust your plan if needed. Make one thoughtful, data-driven adjustment based on your journal. Day 24. Practice saying no to temptation. When tempted to trade outside your plan, pause and say no. Day 25. Visualize your trading success. Spend 5 minutes imagining yourself as a disciplined, successful trader. Day 26. Share your journey. Talk about your discipline challenge with a trusted friend or mentor. Day 27. Write a letter to your future self. Describe how discipline will help you succeed and stay focused. Day 28. Revisit your trading goals. Update or reaffirm your goals and commit to them. Day 29. Plan your next 30 days. Set clear intentions for continuing discipline beyond this challenge. Day 30. Reflect and commit. Review your journey and make a firm commitment to disciplined trading. Going forward, final thoughts on the challenge. Discipline is not a switch you flip overnight. It's a muscle you build through daily effort. This 30-day challenge is designed to guide you through that process. By the end, you will have stronger habits, sharper focus, and greater control over your trading decisions. Remember, the goal isn't perfection, it's progress. Some days will be easier, some harder. The key is persistence. If you stay committed, you won't just trade better, you'll think like the 2%. And that makes all the difference.